Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at Exchange, an ETF experience where we're meeting with the top thought leaders and innovators in the ETF space. Joining me for this segment, we have Eric McArdle, Senior Vice President of Advisor Solutions over at Simplify ETFs, to discuss maintaining long exposure in volatile markets. Eric, it is great to meet you in person. Welcome to Trade Talks.
Likewise, Jill.
And growth stocks, of course, have been under pressure over the recent few months. What does Simplify make of the most recent underperformance and volatility that we've seen in the market?
You know, I think it's something for investors where you've had this decade or more of growth dominance, and these are the stocks that everybody wants to own, right? But the problem is, in recent months, the last year, we've had some volatility in the space, we've had some leadership rotation, and I think it's made people kind of question, okay, is there a regime change? Is there something I need to do? You know, are interest rates going to create a headwind for growth? And it's been really hard to stay the course, right? But I look at it from the perspective, and Simplify does, of, okay, these are long-term leaders. Sure, they have some hiccups, but finding ways to give advisors tools and ideas for maintaining long-term exposure while protecting against some of the downside, I think is really what we're focused on.
So how is Simplify thinking about maintaining long exposure despite those macro concerns?
So what we do is we really focus on capturing everything good about the underlying beta. So we want to have as much of the exposure to the Nasdaq 100, for example, as possible. Own about 97 to 98% of that, and then slap on a catastrophic insurance profile that's using deep out of the money put options. And I think of it kind of like a rubber band in a sense, right? You don't expect a lot of protection early. There's not a lot of tension when you first pull, but as you get further down into a drawdown, that protection becomes worth a lot, and that really hits on a concept called convexity that we focus on here at Simplify.
And we've witnessed a lot of innovation in the ETF space over the past number of years. When we're hearing about all the products now at the Exchange conference, what are some interesting exposures that might not have been available in the past that can help investors now navigate challenging markets?
I think having options in ETFs is really interesting, right? And a little bias there, obviously, but we have tried to work within the landscape and work within the new regulatory framework that's allowed by the SEC and others to say, hey, let's take these strategies that were normally allowed in hedge funds, or normally, you know, that's where investors would get access to them. And let's bring them into an ETF that can be purchased for, you know, a single share, 25 bucks, and really, you know, I hate to use the term, but democratize this access, right? And so we're doing things like that, right, where we stick with the core exposure as described earlier, and we'll slap on, you know, kind of an embedded overlay. But then we also have some other strategies where we're looking at specific portfolio problems like rising interest rates, right? And creating strategies that really just focus on that issue alone, giving advisors a way to put that into portfolios and have a convex potential payoff if rates go up. Ticker for that one is PFIX, so very timely when rates are moving as they have.
All right, and what kind of strategy does that employ? Is it just looking at specific asset classes or equities?
Yeah, so when something like that, we have a 5-year treasury notes, that's kind of the ballast, and then you have a portfolio of swaptions, which are essentially long-dated put options on forward interest rates or forward bonds. And so for us, we just really view it as that. We say investors didn't have access to these ultra long-dated swaptions up until recently. We packaged it in a single QSIP, and then people can just go buy it for, you know, $55 a share.
Yeah, great for advisors. All right, Eric, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.